the really key question that we ask everybody: what age would you like for work to be optional, and what level of passive income makes work optional? There is lots of people out there that say rent vesting is the best thing you can do. In my experience of 25 years of advising people, it never works.
How would you recommend the unadvised listener goes about thinking about this decision?
Everybody is different, but everyone wants the exact same thing. So,
which is
there's almost no point having a bunch of investments generating 7 or 8 or 9% return and a whole bunch of debt that's costing you 6% after tax. The maths just doesn't work.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. This is a momentous episode for us.
Yeah.
For eagle-eyed or eagle-eared listeners, they will have heard that we've just moved studios.
Yeah.
And today is our first interview in our new studio, and there's no better man to be joining us for this interview than a long-time friend here at Equity Mates, Charlie Viola of Viola Private Wealth. Welcome back to Equity Mates.
Thanks, gents. Wow, I'm honoured. I get to break the cherry on the new on the new studio.
So no pressure, but we're expecting big things.
Yeah. Well, it's all going to be downhill from here, right?
Hopefully not. No.
No, super well done, guys. Obviously, I've been watching your journey over the last 4 or 5 years, and to come into a studio and a building like this is a testament to the work and the effort and the trust that people have in you guys. So super well done.
Well, thank you for the support. Do you remember the first studio we met in the Batuta Studios in Surrey? That was a little sweat box.
Yeah, I do. It was really hot in there.
It was.
And even the second one where you had to keep getting up and closing the window because the traffic was going past.
Well, a few things have changed.
We appreciate you. You've been a big supporter of us over the years, so it's been great.
Now, this is a format that we love doing with you, Charlie, Ask an Advisor, where we get questions from the community. But given your experience in the wealth space, we asked you for the enduring principles that you talk about with your clients when it comes to building wealth. We want to unpack 3 of those today. There's understanding the context of your client's situation, making sure that you get the structuring right, and then, of course, making good investment decisions that are enduring over time. So let's start with understanding the context of your clients, because everyone listening will have heard the disclaimers that we put out, that a lot of advisors put out, which is general advice only. But so why is understanding personal circumstances always the starting point? Why is it actually important?
I mean, fundamentally, it's the key to what we do. So, making investment decisions without context, making investment decisions without understanding what you're actually trying to achieve, will end up in failure of one kind or the other. So, fundamentally, what we do with every client is ask them where they're at, what they're doing, what they're looking for, and what they're trying to achieve. And it's the answer to those questions that gives us the ability to make the decisions around how we structure their money, and then ultimately where we invest their money. We understand in everything that we do, there's no false economy. We have to produce good investment outcomes, or they could go and do it themselves. But before we can make good investment decisions, we have to understand what we're actually trying to achieve for them. We have to work out what's actually rocking their world. Like, we talk a lot to clients about, in 5 years or 7 years or 10 years, where do you want to be? What do you want your life to actually look like? And then we talk to them about, well, what does it look like today, and what's the gap between those two things? I've said a lot publicly, and you guys are no different, right? You guys are the most pro-equity guys in the world, but even you guys at your ages have gone and got your housing sorted, right? Yeah. So we talk to clients about getting their housing sorted, because once their housing is sorted, then the rest tends to follow in terms of their ability to grow their wealth and get to a point where work can become optional. There is lots of people out there, and usually they're guys who are trying to sell people investment properties, that say rent vesting is the best thing you can do. And, if you model it out mathematically, it works better. In my experience of for 25 years of advising people, it never works. People get FOMO. People feel like they don't have, a stake in the ground. Therefore, we talk to clients a lot about make sure you get your housing sorted, and then the rest of the wealth accumulation stuff can come after that. Because ultimately, if people aren't secure in terms of where they're living, how they're living, where they want the grandkids to come back and visit them, that it makes it very hard to make other long-term decisions, because there's always the thing in the back of their mind going, well, what happens if I change my mind, or what happens if I want to use the capital for something else? So we ask clients, in 10 years' time, what do you want it to look like? And the really key question that we ask everybody, what age would you like for work to be optional, and what level of passive income makes work optional? And it's very hard to answer those questions unless they know how they're going to afford to live and where the roof is going to be.
Love that question.
Yeah.
When do you want work to be optional?
Tomorrow.
Yeah.
No, it's not as simple as...
Which then follows on to
You're dreaming.
What level of passive income makes work optional.
Yeah.
And if there's clearly a massive gap between what they want and what they've got, then you've just got to educate them on that, and you've got to get them to be realistic about it. That's all.
Yeah. So I think you've given a few factors there, but for the unadvised listening who may want to do a bit of a self-assessment, can you give us a bit of a checklist to run through when you always hear the disclaimer, general advice only, consider your personal financial circumstances. And then no one ever says what personal financial circumstances you should actually consider. So what's a bit of a checklist that we can run through in our heads?
The first one is what do you want your living situation to actually be? So, again, you guys are really pro-equity, but you've still gone on board housing because you know that it's going to be an easier way to support your family, look after yourself, know where you're going to go every day, use it as a base for life. Work out what you want to do from a housing point of view. Then secondly, from there, work out what you're actually trying to achieve in the next phase of your life. And thirdly, after that, it's what level of passive income do you actually have, or what level of excess income do you have? Are you spending less than you're earning? If you are, great, then you can start savings plans. What I've probably worked out over 25 years is everybody is different. Everybody's situation is their own. But everyone wants the exact same thing. So, everyone wants the exact same thing.
Which is
to be really secure from a housing point of view. And then for us, when we're managing their money, is don't blow it up. Hold good assets, generate revenue from it, make it grow over time, right? Like everybody's situation is fundamentally exactly the same. What people use their money for is different, and different people at different levels of wealth will have different ability to afford, different toys and houses and race cars and whatever else, right? But fundamentally, everybody ends up in virtually the same position where they want to feel really secure from a housing point of view, and they want to know that when they turn the tap off from an effort component piece in their life, that there is going to be a secure income stream that is flowing through from their investments. So ultimately, the self-assessment piece is, well, what do I want to do from a housing point of view, and how do I get to that point? Then once I've actually got to that point, what does my balance sheet look like, and how do I utilize my balance sheet? How do I utilize the equity in my home to be able to produce some wealth? Then what does my income versus my expenses look like? And how do I combine those two things to actually be able to generate enough wealth so that in 5 years or 7 years or 10 years or in 15 years, I've actually got enough to be able to produce that passive income that I need?
One thing we didn't talk about there is risk tolerance and stuff like that. I guess, are you doing a survey with the client and saying, all right, well, they don't have a high risk tolerance, so they're, we're going to put them in more conservative investments? Or how much of it is, if they don't have a high risk tolerance, I'm going to educate them on the right way to invest?
I think my views are probably a bit controversial about this. We risk profile our clients, and then we almost ignore the risk profile questionnaire that they provide us, because fundamentally over time, it's a bit like saying, if you use like a sporting parlance or a sporting analogy to say, I'm an aggressive batsman or I'm a defensive one, well, really, you should just play every ball on its merits and, you're whatever's in front of you. Fundamentally, what we believe over time is that certain assets perform a certain role and produce a certain outcome, and you should hold a certain number of those to be able to produce the outcome that you're actually looking for. So the risk profile questionnaire really is just to give us an understanding of where the client is starting from, their understanding of how assets perform. And then our job is to educate them and build up those portfolios to make sure they're generating the outcomes that they were looking for based on the context of their actual goals. So if you look at basically every advised, high net wealth client, every portfolio fundamentally is going to look from an old point of view or an old terms point of view, like 80-20, growth assets to defensive assets. That's how they're going to look, because the growth assets have grown, equity markets have done nothing but go up. You've had this creep in terms of those assets. As they've gotten wealthier and got more money, they've got access to infrastructure and private equity, etc. And they've decided that the returns on defensive assets or lower risk assets aren't exciting enough or aren't generating the right outcomes. And they know that fundamentally it's actually those growth assets that are generating the vast majority of the revenue for them as well. So it's just really a matter of educating the client over a period of time as to the type of assets they should be holding.
Do you judge your success on the client meeting their goals, or as well as delivering a portfolio that has delivered something that they couldn't have done themselves?
Yeah, I think there's probably three things that we judge ourselves on. One, we want to be the trusted advisor. So when the roof falls in or the kids get sick or something happens in their life, we want to be almost the first one that they call to work through how you actually get to the solution for them. So you want to genuinely kind of be there for them around all of those things. But ultimately, yeah, we want to be able to produce outcomes that helps them meet their needs so that they can go off and live happily ever after. So where they take a little bit less interest in their financial situation is when we know we're actually doing a really good job. So where they want to, be across every line item and see exactly, what's going into the bank account all the time, we feel like they're either not trusting us or we're not doing a good enough job in getting them to go and, live their life to the fullest that it could possibly sort of be. But ultimately, again, we understand there's no false economy here. We understand that we have to produce better returns than what they can do themselves, and we have to give them mathematical peace of mind. What we do for every client, at least every 12 months and generally every 6 months, is we actually provide them a projection of revenue, because ultimately it's that revenue that they're going to live on. So we give them a list of every asset that they've got and show them exactly how much income is going to flow from that particular asset, so they can feel really comfortable as to where their passive income stream is up to. Now, whether the client's still an executive and 45 and still working and earning $1 million a year, or whether they're 65 and now relying on it, it's still important that they see that revenue production and that revenue growth over time. And it's as simple as saying, if I own 1,000 CBA shares and CBA is paying a dividend of $4.20, I know I'm getting $4,200. If I own 1,000 Woolworths shares and Woolworths is paying $2.20, I know I'm getting $2,200. If I've got $100,000 in a industrial property fund paying a 7% distribution, I know I'm getting $7,000, and so on and so forth, so that they can see exactly how much income is going to flow into the bank account over time, because that's what's going to give them the mathematical comfort that they're either producing enough or they're not yet producing enough, and therefore we need to keep adding to the pot to be able to produce enough over time.
The first principle was understanding the context of their situation. The second one was getting the structuring right. And I think, just from a definition point of view, what does structuring mean in this context?
Structuring from a tax and structuring perspective in Australia is actually really simple, right? People like me, and especially accountants, try and make it sound really complex. That way they can kind of get paid more. But ultimately it's pretty simple, right? When you think about it from an investment perspective, we actually only have 4 tax structures available to us. You can hold assets in your personal name, you can hold assets in a trust, you can hold assets in a company, or you can hold assets in superannuation. That's it. That's the sum total of the complexity from an Australian investment perspective when you're holding investment assets. Those 4 structures obviously have differing tax rates attached to them. The purpose of the structuring discussion is just to ensure that you're getting to keep as much of the money as possible, because ultimately the investment decisions that you make within each of those is going to be broadly and ostensibly the same. A good investment is a good investment, whether it's in your super fund, in your trust, in your company, or in your personal name. But ultimately, each of those 4 structures have got different tax rates applied to them on how income is actually dealt with. So the reason we use the structures is 2 or 3 things. One, it's efficiency. We want to keep as much of the money as we can. 2, it's asset protection. So where you've got people in higher risk jobs, where there is a chance of somebody coming along and suing them for whatever they're doing. I personally don't hold any assets in my personal name, and while we run a really good quality, compliant, heavily governed business, I'm an advisor, right? I work in professional services, and you'll find that virtually nobody in professional services hold assets in their own personal name. So we talk to them about the risk profile that they sit. Doctors won't hold assets in their personal name.
I was just thinking, so my wife is a doctor.
Yep.
So what's the right structure for us?
What about podcasters with a large audience?
So we don't have the assets to get started.
Yeah, true.
So while for all of those jobs, you're all going to have professional indemnity insurance attached. Generally speaking, if somebody gets really upset, they're going to come and try and find, the person who's upset them the most. And, obviously nobody wants creditors following them around kind of thing and administrators following them around. So asset protection is an important one. But ultimately, the most important thing there is efficiency. The chance of actually getting sued in any of these jobs is actually a very low possibility. It's not really the reason you do it. It's mainly the efficiency piece. It's important, though, from a debt structuring point of view, that where you've got non-deductible debt, home loan debt, you try and belt it. You try and pay it off.
Yeah.
If you're carrying deductible debt, investment debt, that's absolutely fine, as long as you've got the income and the cost in the name of the highest marginal tax rate payer. First day blues, right?
Context is something just fell off out of the studio background. So
Nothing catastrophic though. So I think it was just,
a few books.
The structuring piece is important, but it has to be then developed over time. What I would say to everybody is kind of try and stop listening to too much of the noise around superannuation and understand that it's going to be the most tax effective structure that we ever have available to us. Even if they keep buggering around with it and trying to shorten the wick on it in terms of how tax effective it is, it's always going to be the most tax effective. So however old you are, make sure you're treating your superannuation monies as a genuine set of investments, making sure that you're investing for the long term and generating those good quality returns over time and making contributions where you can. If you're young and you've got a good job, make sure you're making the maximum concessional or pre-tax contributions you can, because it's good enforced savings and you get the time value of the money in the market over a really long period of time to grow that nest egg.
I mean, you've said it on the show plenty of times, your famous quote, get the money in the right buckets. For someone that's just thinking about this themselves, how do you start that process? What are the sort of considerations, to make sure that you're not buggering it up at this point?
Firstly, it'll depend on where your situation is, right, in terms of how much personal debt you've got, and whether or not you are in a situation where you are negatively geared or positively geared. So ultimately, the purpose of the structures is to ensure that you're getting all of the positive income into the lowest marginal tax rate payer in your group. So this obviously requires going through a process of understanding where you're at, what you've got, how much debt you've got, and how much passive and positive income you're actually generating. The reason we use trusts, and what I would say is, generally speaking, you'll only use a trust if you've got a slightly bigger amount of capital to invest, because there is a cost to utilising the structure. But the reason we use trusts is because it gives us flexibility in terms of what we do with the income. So it provides that layer of asset protection, but the real reason for using it is flexibility around what happens with the excess income that's being generated out of the investments. It sort of just ensures, and the way we sort of talk to clients about it, is that where you're generating positive passive income, we can have a maximum tax rate at the company level, so at 30%, because once you've distributed to an individual above the 30% tax rate, we can start to distribute to what we call a beneficiary, or a bucket company ensures that the income only ever gets taxed at about 30%. Those bucket companies are very much just tax deferral mechanisms. They just kick the tax down the road, because if you want the money back out of the company, you've obviously got to pay the top-up tax. But if you can either delay that forever, if you've got enough money, and create legacy, or delay that until you've got most of your money in superannuation and you're on a lower marginal tax rate, then obviously you can stream that income back to you and you get the franking credit. If you remember a couple of years ago, Shorten lost the election off the back of the excess franking credits issue. What he was really attacking was people doing this. He wasn't attacking little old ladies with CBA shares getting their franking credits back. He was attacking people using these tax deferral mechanisms, paying less tax over their lifetime, and then streaming the income back to themselves and getting the benefit of those franking credits.
Wow. I mean, I got a little bit lost, but I guess that's why we need to go get advisors. So I guess for people who are trying to do it themselves, obviously, like you said earlier, you can make it as complex as you want, and there's a lot of benefit to speaking to someone like yourself and really getting it right. But for people who don't have an advisor and they're thinking about getting the right money in the right buckets, how would you recommend the unadvised listener goes about thinking about this decision?
Firstly, if you've got a whole bunch of non-deductible debt, you're still paying your home off. That's a good use of your money. Remember, you're getting a risk-free, 5 or 6% return. You're sorting out that kind of first fundamental of wealth creation, which is working out where your housing is going to be, and you're not leaving that run too late. In terms of, most people will generate the vast majority of their retirement capital from sort of 52 or 53 onwards, because generally speaking, it takes that long to get to the point where you're debt free, you've got more excess income, and your life just maybe gets a little less expensive in terms of, having, kids and school fees and all the sort of things that go on in life. So if you can start to punch some holes in your non-deductible debt, you're often going to be in a really good position in the last kind of 10 or 12 years of your working life to actually build that nest egg to the point where it can sort of at least sustain your lifestyle.
I remember something that stuck with me about a year ago. You were saying if we have a mortgage but we still have investments outside of the mortgage environment, then what are we doing?
Yeah.
Effectively use that.
That return on your invested capital has to be like so much better than the cost of your capital on your mortgage. Like you have to be hitting it out of the park effectively every single year. And maybe you are, but most people won't, right? But, most people just won't. So ultimately, we think that there's obviously ways of doing that. There is the old debt recycling where, pay off the debt, reborrow the money, have the money then reinvested. Then obviously you're using deductible debt monies to actually run those investments. So it's a good opportunity to go and get advice around those things. But there's almost no point having a bunch of investments generating 7 or 8 or 9% return and a whole bunch of debt that's costing you sort of 6% after tax.
Yeah.
The maths just doesn't work, right? So your cost of capital is just too high, and you're needing for that investment stuff to work harder with a bunch of risk attached to it versus the risk-free stuff of just paying off your mortgage.
So Charlie, that makes a lot of sense, but then the logical outflow of that is if people are just really focused on getting their home loan to zero as quickly as possible, clearing that non-deductible debt, then that creates a situation where they may not have a lot of assets or investments outside of that that house that's now almost paid off or fully paid off. How do you think about that scenario? Yeah,
remember before we said that the structuring is important, and so is using your balance sheet. Yeah. So what you've now done is you've reduced your living expense fairly significantly, and on the basis that you can maintain a level of discipline, that $1,000, $2,000, $5,000, $6,000 a month that you were sticking into the mortgage, you've now got as excess income. What you should be now doing is utilising that. And if you have the courage in your convictions and you are assertive enough from an investment point of view, go and borrow some of the money again and start to make some good quality investments, and start to use that excess income that you were generating, that you were paying down your mortgage, to buy assets and start to build again with the real comfort and knowledge that your housing is sorted and you're now building up on your investment assets. Secondly, if you've been taking the advice that everybody's been giving since 1994, you've also been making super contributions. So you're also building up that nest egg in those good quality long-term investments. But you've got that first kind of principle sorted. Housing sorted, know where we're going to be, know we've got a bunch of capital, we've got a really good quality. If you think about any company, how do they generate returns? They use their balance sheet. No listed company or no good quality company's got no debt on their balance sheet, right? Because investors or the shareholders will be going, well, what are you doing with what are you doing with the balance sheet? You need to go and utilise the balance sheet. Utilise your balance sheet, but do it at a level that you're comfortable, and then use that excess income that you've now got in your situation to help you build up the portfolio again.
Just to close out the bucket piece on superannuation, hypothetical scenario, 34-year-old guy who has come to you and says, I want you to turn my money into as much as possible in 10 years' time, not so concerned about passive income. How are you suggesting this hypothetical person approaches superannuation?
Like a good quality set of investments that have got, quality, diversity. There's really only one way to invest. That's buy good quality assets that generate revenue through the cycle and generate a good outsized return. Where you've got no wish for income, that's fine. If it generates income, it just gets reinvested. And then, like I said, you can probably start to have a slightly greater exposure to equities, private equity, infrastructure, where liquidity isn't an issue for you. But ultimately, the best returns over time come from asset allocation, diversity, asset quality. So those fundamentals just basically remain, you know what I mean? So we could all swing for the fences here. We could all go and hope that we're producing kind of 5 and 10 baggers. We just won't, right? We just, you might get lucky on the odd one, but fundamentally over time, you won't. So good quality assets that are built into good diverse portfolios is where you're going to generate the best returns.
And what
over
about
time.
the philosophy about actually putting more into super though?
I'm a big believer, even when you're carrying, and not to be contradictory, because it's good enforced savings, where you're on a reasonable level of income, remember that the 12.5% or whatever the SG requirements are is going to end up being reasonably significant. I think the average wage in Australia now is like 110 grand or something like that, which means that most people are putting 15 grand in. It's not that much of a stretch to actually then go to the maximum concessional amounts, which is 30. I think people should do that. Tick the box on their employment form, do it, set it, forget it, make sure money's going into super, make sure it's being invested over time. It's easy enforced savings, and you'll get that benefit of the cumulative effect over time.
Okay.
Because you think about it, the hypothetical 34-year-old who's, whose name might rhyme with mice, you've effectively got 26 years of cumulative returns. Just do the maths of 26 grand at 30,000 at 8 to 10% returns annually, and you end up with a reasonable sized nest egg at the other end.
Yeah.
But what he doesn't get to do is buy the car in 10 years.
But you do, because as your income goes up, it's going to hurt less and less having put that extra 12 grand a year in, because your income's going to go up and you're already maxing the super contributions. So as your income progresses and as your career progresses and you continue to kind of get paid more, which naturally most of us do, right? Like as you get more experienced and people like the skills you've got more and more, that impost on you in terms of your take home versus what goes into super actually falls.
Yeah.
But you're creating enough wealth over there to know that there's going to be a nest egg at the other end.
Okay.
So
noted.
Has that hypothetical 34-year-old covered what he needs?
Yeah, that's good.
I reckon that hypothetical 34-year-old may have a few more
I'm looking forward
questions
to the
coming
next
here.
section.
But we've covered, understanding the context and the personal circumstances, then getting the structuring right, the right money in the right buckets. Now let's get to the heart of the matter, where you guys, I guess, really excel at Viola Private Wealth, which is making good investment decisions.
Yeah, this is our enduring service, right? So this is what we believe we do really well and have done really well over 20 odd years. It's the enduring piece of what we do, because fundamentally it is the production of the good investment outcomes that help people meet those goals over time.
Now, we want to get to like what goes into that, but before that, I just at a higher level, you saying that, like, not every advisor would say that's their value proposition. We've seen the rise of SMAs and managed accounts and all of that stuff, model portfolios, where a lot of advisors kind of outsource that to third parties. But you guys are sort of bucking that trend. Like you are planting your flag and saying investment returns is why we are who we are. Why do you sort of buck that trend in the industry?
Yeah, so each to their own, and I know the arguments of SMAs, and I know the arguments of really smart asset consultants putting together portfolios and doing thousands of hours of research and building theoretical portfolios. Every time I see an asset consultant, the only thing I can say to them is you've clearly never spoken to a client in terms of the way that they build the portfolios. I'm not any asset consultant's favourite person in the world. Every time I'm on stage with one or whatever, I just can't help but take the piss out of them and just go, like, we would never say that to a client. How can we deliver the outcomes that we're looking for a client in terms of liquidity needs, revenue production needs, access to capital, risk profile, unless we're building portfolios in the context of what they're actually trying to produce? how can we as advisors, like it's incumbent upon us to understand what we're trying to achieve and build the portfolios around that. Now, ultimately, the tools that we use for every client will be somewhat the same, right? If we have a view in terms of equities and we have a view in terms of how we'll solve the equities piece, we're going to solve it for most clients in the same way. But what's important is how much we do, what liquidity constraints we put around the investments that we generate. And then ultimately what we want to do for clients is we want to build out those portfolios to make sure it's delivering the outcome that they actually want. If all we do is go and stick them into a cookie cutter SMA and tell them it's somebody else that's really smart has put this portfolio together, how are we displaying any value? Like, how are we displaying to them that we know their situation and we understand where they're going to get the capital back if they need it? We charge the clients a fee, right? We charge the clients a fee. Ultimately, we charge the clients a fee to manage the money for them. So it's incumbent upon us to actually manage that money for them and then show them the decisions that we're making, the activeness that we're taking over time, and the attention that we're giving to their portfolios and the different parts of the portfolios is delivering them an outsized return versus what they could actually produce themselves. We want to talk to the clients about each bit of the portfolio and the role it's meant to play. And, which bit's actually providing the liquidity, which one's doing the heavy lifting on income, which one's intended to generate the outsourced capital growth. If we see changes in the market, we see opportunity, we see weakness, then we will start to swivel in terms of how much we put in any particular asset class. And it's that discussion with the client around what their goals are and what we think we can achieve based on the economic environment, the types of investments that we have available to us, that is actually adding value to their situation over time.
Makes sense.
Love that.
So that's the task you guys have set yourself at Viola Private Wealth. How do you actually go about that? What's a good asset to you guys, and what's your process for making good investment decisions?
We say to every client that ultimately, through the cycle over time, we're trying to generate 8 to 10 to 12%, right? If we look back over the last 15 years, returns on our client portfolios have been much better than that. But we've had a 15-year period.
Set the bar low.
Yeah, well,
Yeah.
it's more
8% deliver 20.
It's more so that, like, over the last 15 years, returns have been really good because markets have done nothing but go up. We had emergency low interest rates. We've had
Stocks always go up, Charlie.
that's all they do. Since GFC, that's all they've done, right? They've done a heap of the heavy lifting, but we've also had, like I said, emergency low interest rates, asset values roaring their heads off. And we've gone through this period where a bunch of these kind of mega cap tech companies have reshaped what multiples should be, right? Like, previously, what was a big multiple on a stock was 15 or 16, and now it's like something inordinate, right? It's 40 or 50, right?
Yeah. Palantir trades on 600.
Yeah. So, we say to them, we are the stay rich business and we are an accumulation of wealth business. We're not a get rich business. So what we want to do is we want to protect their capital and we want to generate revenue over time. If somebody, sells their widget factory or podcasting company and brings us a bag of 30, we say to them on day one, we say, it's going to take us a good 12 or 18 months to fully deploy your capital for you. We're not going to just go and stick it in a model that somebody who's never faced a client has suggested is a good idea. We will do the defensive ends of the portfolio pretty quickly because we know that it's there to protect the capital and generate revenue. The higher risk ends of the portfolio, or the equity end of the portfolio, we will do over a period of time because we do want to invest into weakness and opportunity. We want to get set. We want to be generating revenue. We want to be generating some earnings growth, but we don't want to use up all the bag at once. We want to make sure that there's an opportunity for us to dip back in when we see weakness or dislocation in markets. We do a lot, and you guys have spoken to Daniel Kelly, our CIO. We do a lot of work around 2 or 3 things. The first one is asset allocation. We're a big believer in asset allocation. We actually believe that 85 to 90% of your return actually comes from good asset allocation over time. So we will always want an allocation to all of the various asset classes. And we write that down and we say to clients, we don't ever want to particularly over apex any one asset class, regardless of what the return might be, because all that means is you're taking a greater level of risk for the return that you're getting. We draw a matrix for clients which plots the amount of return they're getting for the risk they're taking, and we always want to sit on the right side of that. As we build out those portfolios and as we work out what the asset allocation should be, we then work out what assets we actually want to buy within each of those. We do a deep set of due diligence. the public market stuff is pretty easy, right? I think I heard on one of your shows, somebody came along and said that indexes are really important because the good stuff floats to the top, right? That's actually really true, right? So where you're looking for public market allocations, it's actually not that hard. Go and buy good quality stuff where companies are proven, they're producing earnings, they're well run, they've got good balance sheets, they protect their margins, gobble up their competitors, right? Use that to generate your kind of public market stuff. It's the private market stuff where we're going to add the most value to clients. We're going to get access to stuff other people can't do, and we're going to have opportunities to invest for normal private clients the way an institutional or family office investor can. And we work really hard around manager selection, around due diligence in terms of where we're putting client monies into. We like things like infrastructure, right? We like infrastructure investments because good, quality, safe, generate revenue, inflation protection, etc. We also like private debt and private credit. Regardless of all the noise that goes on, right? Private credit or private debt is a spectrum. There's low risk stuff, low LVR, good sponsor strength, first loss provision, and then there's stuff that looks like equity. We don't want our defensive assets performing like equity. We don't expect that our private debt investments are generating 12 or 13%. We want them to generate 7 or 8%. We want it to protect the capital. We want it to perform that role within the portfolio. If we want equity-like returns, we'll go and invest in equities. So we work really hard to kind of slice the portfolio up into the right asset allocation and then the right assets at the right time. You've all heard me say before, we always want to have some powder dry. And whether that powder's dry because of liquidity in some of those buckets or cash, we can probably use the example of the Liberation Day and markets obviously fell off a cliff as Trump tried to get rid of his trade deficit straight away and gave the world a big shake and a big scare. We had something like $500 million of client money sitting in cash or accessible liquid fixed interest style investments at that time. During the period from April 4th to 9th, and I think the 9th was the low point in the market, we deployed about 150 mil of client monies into global equities because Daniel, our CIO, and we as a business felt like markets had been oversold. We didn't feel like where they'd been sold to was going to hold. We'd taken value on global equities a few months prior to that. We looked a bit silly because markets kept going up, but the multiples were starting to get really big and starting to get out of kilter of what we felt was the right risk return sort of parameter, I guess. So that gave us an opportunity to actually go back in, and that's what I mean by being attentive and making sure we understand how much cash the client's got, where they're invested, what their risk profile is, and what's left in terms of what we can allocate to those asset classes.
So from an individual client point of view, how much of their portfolio generally, like a blended average or whatever, would be in cash or like highly liquid defensives that could be turned to cash quickly?
It'll depend on the client, but there's always going to be something like it. There's always at least 5 or 6.
The hypothetical 34-year-old that we were referencing earlier? Like how much of that would you be thinking like cash or liquid to be tactical?
There's always going to be something like 15 to 20%. Because generally speaking, we're still going to be able to generate reasonable returns out of those parts of the portfolio. And ultimately, having the ability to have powder dry and take advantage of good opportunities that come along or weakness in markets will actually drive medium to long-term returns, right? You have to have the opportunity to take bites at the market when the markets fall heavily. We talk a lot at Viola Private Wealth about signals versus noise. We work hard on understanding the signals. We send clients an email every Monday morning. I'll include you on the email.
That'd be good. Yeah. We'll use that stuff as
about what the signals are. So what markets are doing, what the VIX is, how much risk the market is kind of pricing in, what earnings numbers are doing, and where we see a disconnect between pricing and those signals. Forget the noise. We try and forget the noise. It drives obviously sentiment. That's when we'll start to actively go back and have a look at clients' asset allocation. We always want some powder dry. We want liquid ends of the portfolio so that we can actually, but we also then want to cater for the fact that this is real people's money and they're doing real things with it, right? So when Bryce sees the McLaren and wants to go and buy the McLaren, if he wants to buy the McLaren, he wants to buy it. We're going to go and find the money from somewhere. So.
One asset class I don't think I've ever heard you talk about about is residential property. Having spoken to many other advisors on the show, it's kind of like the first go-to when it's the next step. It's like, debt recycle, the advantages of leverage and being able to negatively gear. Like, there's a lot of setup that is favourable, but it's something I've never really heard you talk about.
Yeah, so firstly, I do think it's a good place to live. But, we're probably driven a little bit by our client type. Our average client is kind of 10 or 15 mil plus of investable monies, and therefore have probably done the resi property thing. For people in that wealth accumulation environment and people who are growing their wealth and are using their balance sheet and want the leverage and are comfortable with the leverage, I'm all for doing that, right? Like, I'm all for people using that. What you've probably found over time, though, is that the real return on that is actually much lower than what people realise. So people get excited by negative gearing. People forget that it's negative means you're losing money.
Yeah.
So if you hold an investment property for 10 years and it goes negative for 10 years, you've got to add up all those negatives and hope that the capital gain was greater to obviously outperform the negative, right? And if it's heavily negatively geared, where you've borrowed 90 to 100% of the capital value and you've had significant hold costs all throughout time and you've had maintenance costs all throughout time, the return on your invested capital actually isn't going to be that much. There's probably lots of modelling around to suggest that you use all that negative capital that you've got and you go and buy, buy equities over time, and whether or not you end up with a better outcome. I'm a big one for people using their balance sheet. I'm a big one for people getting out and making good investment decisions. I think pinning your hopes that the investment property that you buy for 650 grand is going to turn into $2.5 million over 10 years is like, it's a fallacy, right? Like, for some people it will, and there'll be, nobody's ever told you the bad story. They've only ever told you the good one. So I'm just mindful for people to understand what the hold costs of those assets are and whether or not they're actually a good investment over time, because they feel like a good investment. They feel like that you've got this kind of enforced savings. I would argue to people, use super as your enforced savings because you know that you're getting an accumulation of value over a period of time. Then use that excess income to build up good quality equities portfolios that are more diverse, generating revenue for you, etc.
Just leverage into stocks.
Yeah. So it's more about leveraging into good quality portfolios. It doesn't have to just be stocks, right? There's there's more asset classes than just shares, and you're getting good.
We're the index boys, Charlie.
Yeah.
We're the index boys.
And there's absolutely
we'll edit that bit out.
and there's absolutely nothing wrong with that, right?
I think it's really easy to buy stuff, and this podcast is all about finding stuff to buy. It's a lot harder to I guess manage that portfolio over time, know when to sell. How do you approach the assessment, rebalance, sell, all of those parts of the investing cycle?
Yeah, that's our job, I guess. I mean, assessing how portfolios have performed, we produce minimum 6 monthly reporting to clients, 30 June, 31 December reports. We show them how their portfolio has performed, what's done well, what's done poorly, how it's performed versus market. And then we try and highlight for them the bits of the portfolio that have outperformed and underperformed. What we do, though, is we show them very clearly what their asset allocation is. So what we started at, what it is, how we feel markets are actually going. It's a rebalancing back within those risk parameters, or at least a conversation with clients in relation to those kind of risk parameters. It's okay to take risk as long as you're being rewarded for it.
And so 6 month rebalancing is kind of the rule of thumb?
So it's a 6 month review, whether we rebalance every 6 months. What tends to happen with bigger portfolios is they get bigger because they produce their own cash. And it's really the use of the excess cash that allows us to kind of rebalance as opposed to selling stuff off. Nobody's ever wanted to sell stuff that's constantly going up, right? Like, that's, emotionally, sentimentally, it's really hard to do, right? And we know that behavioural finance is such that people want to keep chasing the winner. That's okay, as long as we're not continuing to kind of have all of the clients' money exposed to all of the same risks, and making sure that we're using the other capital that they've got to balance that risk out.
Well, Charlie, we always love talking to you. It's been good having you in the studio. The first guest in the studio. You've delivered as always. You are working with a number of Equity Mates audience members. So if you'd like to chat to Charlie and his team, head to equitymates.com/advice. There's a form there to fill in. And if Charlie's the appropriate advisor, we'll get you in touch. But thank you for doing that work with the Equity Mates community. We know they really appreciate it, and so do we.
One hypothetical 34-year-old one-day dreams
yes, a few hypothetical questions offline after this, I think. But we have run out of time. But thank you, Charlie. We appreciate it, as always.
Thanks for having me, gents. It's always good fun. And yeah, again, like super well done in everything you guys have achieved. And again, it's a testament to the community that you've created, the work that you do and the trust that people have in you. So yeah, here's to the future.
Yeah.
Thank you.
Thank you.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.